Welcome to this session of Your Market Navigator. As many of you would be familiar on this platform, it has been our endeavor to present to you our fund managers and analysts. And at times we get our external speakers and external guests also to share their views on the market, on the equity strategy, and just specifically on certain products under focus for that particular session. So today I'm very happy to have our co-head equities Anil Shah. Most of you know Anil Shah has been with IWS and Life AMC for over a decade now, and has a very rich experience on the sales side as well, about 2 decades of experience on the sell side of equities. And for the last about 10 years, little over 10 years, he has been with the ABSL AMC. And through his tenure, he has managed very successfully our ABSL equity fund, which we used to call it earlier ABSL equity. Now we call it ABSL FlexiCap fund. And he has a very sound track record of consistent compounding in this particular fund. And many of the investors have really benefited in terms of their long-term investing in this particular fund. Very happy to share that Anil Shah has started managing our ABSL Midcap fund from mid-2020. And since the time he has started managing the fund performance and the portfolio has kind of got reconstructed, and the performance has really turned around, as you would have seen it in over the last few quarters. Also, it's very topical to talk about manufacturing fund, because it's one fund which we had launched in 2015 and has had a decent track record. And it is again in limelight, particularly with the kind of capex budget government is talked about over the last 2 years. We have seen the increasing focus on PLI, for example, and in this budget, particularly the amount of money that government has budgeted for capital expenditure. What are the implications of all these budget measures, as well as PLI, for example, for manufacturing as a segment? So it's very interesting to know that view as well. So specifically, we'll talk about these 3 funds today in the session. And towards the second half of the session, we look forward to take any questions that you might have, particularly with respect to equity funds and particularly the funds that are being managed by Anil Shah. So welcome, Anil.
Thanks.
And to start with, Anil, I think you have been managing our FlexiCap fund for a while. So if you can just start with your views about currently how the portfolio is positioned, and what's your view, particularly with the budget announcement, and since the beginning of the year, this calendar year, we have started seeing some bit of volatility as well in equity market. So in that context, how is our portfolio position, and what is the portfolio outlook for the rest of this calendar year? If you can just start with that.
So, thank you for hosting me here. Much appreciated. And so as everyone would be aware, I've been running FlexiCap now for the last 10 years. Erstwhile, it used to be called the BSL Equity Fund. It's over the last 10 years, we've consistently kept the small mid-cap percentage in the FlexiCap category to be between 25 to 35%. And, that thing continues. I do understand that there is complete flexibility in this, in this particular category, but my 10 years of buy side tell me that, the fund performance really is much more linear and, much more less choppy with this kind of a weightages of 25 to 35% mid and small caps. So that's how it is positioned even as we speak right now. As far as the view is concerned, I think, to be honest, the easy money part of the market seems to be behind us in the last 12 to 18 months. As we saw retailization of the markets taking place, we saw, globally, all central banks basically going out of their way, because of the pandemic, to give support in whichever form and manner that they could. And that led to immense liquidity, extremely low rates, and, basically people participation in the markets across the world, particularly in India and in US as well, has increased. So I think from that perspective, I think the easy money part of the market seems to be behind us. We are now going to see the world looking to contract the balance sheet. We are looking at inflation being pretty red hot in the US and a couple of other places as well. And we should start seeing, because of this inflation being high, some bit of interest rates moving up. So from here on, I think you will start seeing very clearly differentiation between companies and performances, and hence the stock price movements. So, from that perspective, I think it's time to go back to earnings, time to go back to basics, fundamentals, because the last 12 to 15 months, anything and everything across the markets really moved up. As I said, there's been retailization of the market. The retail participation has been really huge and abundant. And the risk part of the market was taken way behind. There was generally the concept of risk was non-existent in the last 12, 15 months. But I think you'll see some rationality coming back into the markets. And from that perspective, I think earnings growth will start mattering. And we should start seeing, markets becoming more picky and choosy in terms of, what does well and what does not do well. So that's the first thing. I think as far as the positioning of the portfolio is concerned, we've always been anchored to valuations in a way. It's the philosophy of the fund has been always to look for stocks and ideas which are basically giving me reasonable, growth at reasonable valuations. Yes, we are not afraid to take long-term calls in terms of those sectors and themes where we believe that theme is likely to play out over the next 3 to 5 to 7 years, like specialty chemicals. We were early. We are pretty decent large overweight there. We honestly believe that, while the stocks may look expensive today, but we think that the growth could be very consistent over at least a minimum next 3 to 5 years and probably more beyond. So, but basically, as far as the fund is concerned, the philosophy has always remained to buy stocks, to buy sectors where you see reasonable growth and you also have some kind of a reasonable valuation. So I'm very anchored to valuations from that perspective. So as we speak, we are overweight telecom, we remain overweight healthcare as a whole, we remain overweight metals, and we remain overweight private banks. We are significant underweight in consumer staples. We are pretty large underweight in oil and gas. And, that's the broad, and we are, of course, continue to be underweight automobiles. So I think that's the broad construct of the portfolio as we speak. I'm happy to, kind of take you sector-wise if needed. But that's the broad construct, yeah.
Fair enough. So 2 points that you made specifically. One is that the easy money is kind of behind us, and many things, whether quality or not, have kind of moved up in last year and a half or so. And going forward, it's going to be more corporate earnings-driven growth or the asset price movement than backed by easy monetary policy, etc. So we have just recently concluded our third quarter result season. So any specific things that you would like to call out for our viewers in terms of what are the key highlights? And every year for the last few years, we have started, not only us at ABSL AMC, but generally in the market, people have started the year by calling out 14-15% kind of earnings growth expectation, and we end up in mid single digit kind of thing. So how do you really see this financial year and your sort of outlook for next financial year?
Sure. So I think the year began. It was reasonably a mixed quarter so far. But like for instance, IT as a sector, okay, the performance in terms of earnings and growth and was pretty decent and solid. But every IT stock post the results corrected. Again, telling you that the market was already anticipating excellent numbers from IT. And it came as no surprise to the markets that, the IT numbers were pretty good. So you saw a good 15 to 17% correction across stocks, despite, IT doing well in the last quarter and more so even being quite confident that the next, at least 3 to 6 quarters look pretty strong and solid for IT companies. So it's also a lot to do with, what are the expectations that are built into the market. Okay, so while IT as a sector did well and, kind of numbers came through pretty well, we did see some negative surprises, partly coming through in growth of some of the consumer staple companies. We did see, even some of the consumer electronics and consumer discretionary companies also not really performing up to the mark because, we've seen raw material prices, particularly commodity prices, being very high, and not everyone has been able to manage to pass on those to the consumer. We've also seen a little bit of a slowdown in rural India as employment has not really been at optimum levels in the rural side, and that hurt some of the volume growth and sales growth of some of these companies. So I think it was a mixed quarter. Having said that, the year ahead, I believe there will be a few sectors and a few stocks within those sectors. But you will have a few sectors which will continue to be laggards and will not be able to keep pace because, we live in a dynamic world. We live in a world right now where probably, environment has become a very, very important part of every country's policy in terms of how do they want to really, adapt to the new environment in terms of your ESG and in terms of, pollution, etc. We are also in a world wherein there is almost a certainty now that there will be increase in interest rates in the US, and money will move back to the US, whenever there has been massive increases in interest rates. So we live in a world wherein the risk, the risk is likely to move up for equities. And in this context, hence I keep saying that valuations will suddenly matter much more. You need to show basically the results on paper, on free cash flows, on improved balance sheets, and only hope will not do. So if you look at even the internals of the US markets, on an average, leaving the top 2 or 3 names, on an average, US stocks have already corrected from the peak by about 30-35%. The US internal markets is already, showing a decent amount of crackdown. And, we're definitely seeing more short rallies and, longer corrections. But it's not a one-way market any longer. And I think, even in the India early days, we already started seeing, sharp into the markets and then some kind of bounce backs. But I think this is likely to be the flavor of the year, where you will react to every single macro event and keep looking for quarterly earnings to, back your stories that, what's being played out. Yeah.
Sure. So, Anil, one question because you made this point that valuation is very important criteria for you to kind of invest, and you look at growth, but you kind of invest only in companies which are offering growth, but at reasonable price. So now there is quite a few people in the markets arguing that India won't be available cheap any which ways, and in US also over the last 10 years, I mean, people kept talking about valuation concerns, but growth kept on delivering. Maybe now it's correcting, but for a really long period of time, it really kind of kept going up. So why is really valuation important? If you can just create that part for our viewers, I'm sure it's close to everyone's heart in terms of growth versus value conversation.
So look, I think it's important to understand that it's for every rupee that comes into the markets, whether it's domestic or foreign money. Okay, there's always an alternate way people believe that I could get an X return. Okay, now in the last couple of years with loose monetary policies and negligible interest rates, if at all positive, when a lot of countries had negative interest rates, you had almost a TINA factor that there was no other way for you to really beat inflation and park your savings, and equity was the easiest way. Real estate across the world, in particularly India, is a very, very difficult, large ticket, cumbersome process of buying and selling. So equity found its way very easily. I mean, we are dematted. You could be sitting in a you could be sitting in a salon and you could just on the press of a button buy some stocks you want. It's completely digitized. And from that perspective, it was easy. The point here is now with interest rates looking to inch up across and balance sheets looking to contract, there will be questions, and everyone will need to really ask the question to themselves, and particularly the large investors across the world, the pension funds, the college retirement funds, etc., is to, is the risk premium being, factored in or not? Because I do have an alternate now where I can actually get a couple of percentage points returns by being risk-free in a 10-year bond or a 2-year US bond, or for that matter, any other country bond. So I think those questions will come, number one. Number two, there's a time and point wherein there's a famous saying, right? You can fool all people few times, but you can't fool all people at all times. It's the same thing, right? Yes, there is hope in many businesses that the future will be better. But at some stage, okay, there comes a fatigue factor wherein people start saying, look, I don't think, this is really playing out. It's been 3 years, it's been 5 years, we've been waiting for growth and growth's really not come through. And from that perspective, I think, normally when there is excessive liquidity, you don't mind because you have more money to park in, so you kind of not worried. But when the liquidity gets a little bit more difficult to come by, the questions really start asking, do I really need to put money out here? So I think those questions will start coming in. As far as India being expensive, look, we must understand that it's unlikely that India will ever become genuinely cheap, at least in the immediate near future. We must realize we are 135 crore people with a market of our own, extremely dynamic set of this 35 crores. It's a pretty large market, close to 2.7 trillion dollars. Aspiring middle class, which is forever growing. What we've seen in terms of the connect through digital, with the data prices dropping, and with improved connectivity of roads and railways, you're seeing a lot of merger, or basically the distances between the villages and the towns and the mid towns is obviously collapsing. And it's one India. It's a very, very large market for people. And from that perspective, everywhere in the world, all corporates will be interested in India as a market. Remember that. We still have a long distance to go in terms of infrastructure growth, in terms of aspiring middle class, living a better quality of life, so on and so forth. So I think India, I don't see India becoming cheap, yes, but you can have a few companies, a few sectors growing better than the X. So, I've been underweight consumer staples. They probably have the best set of companies, okay, the best brands, the highest ROEs, negative working capital, some of the best MNCs are there. But I've been underweight, the question to ask is, if you're genuinely positive on long India, macro India, and all the demographics of India, why you so underweight the sector? The point here is, I don't think that some of these companies now, okay, if you're selling a toothpaste and a toothbrush and soaps and detergents, in my personal view, these are well penetrated now. It's no longer the story of 10 and 15 or 20 years back, where India and the penetration of some of these things were still low in 50s and 60%. I think today 85-90% penetration of detergents and soaps and toothbrushes and toothpaste, and maybe a little less in personal products, but the penetration is pretty good and competition level is pretty high, and I can't see them growing more than 12-15% EBITDA growth, in which case why should I pay you 60-65 times? I might as well get into something like consumer durables, where improved water supply, because now 24 hours 24/7 is this country's, the governments claim that we want to give 24/7 water in a pipe to people. Okay, that suddenly throws up a lot of opportunity, that if you have 24/7 water and 24/7 electricity, then the effort, and if you obviously have a little bit better growing Indian economy, then probably the growth of washing machines and the growth of refrigerators and the growth of fans and televisions could be much better. And I could probably be there, even though there also the valuations could be at 35-40 times, but so that's the way to look at things, and that's the way you look at things as to where do you see foreseeable, sustainable growth, and is that growth available to you at valuations which are reasonable or not? Everybody would love to buy things cheaper, but as I said, I think India will remain one of the few markets which will remain relatively more expensive for various reasons. One of it is, we must understand that we are now, I think we will soon be the 5th largest economy in the world. 135 crore people, aspiring middle class, consumption of our own. Anyone who sets up a business unit here knows that he has a local market which can be large enough if he gets his act right. And on top of that, if you have improved infrastructure, improved port, improved systems, if you have these things, can also start picking up, as you've seen in specialty chemicals, as you see in generic pharma, and as you see in many other things. So I think, and also India is one stock market which offers you every flavor that you may want. So, there are many markets in this world where they are specialized either in semiconductors or they're specialized in hardware. The stock markets only offer you, largely hardware or semiconductors or, so on and so forth. But in India, you can buy cyclicals, you can buy value, you can buy PSUs, you can buy growth stocks, you can buy quality stocks, you can buy pharma, you can buy FMCG, consumer staples, IT services, telecom. And I think, that's also something that kind of comes along. Also, I think India has sold its story pretty well over the many years. Indian corporates, we adapt to balance sheets and we adapt to the language in English. Okay, we have a very strong corporate law, company affairs, and I think those things are going down very, very well to most investors. So that's why India, I don't think, will become cheap. It's always a relative game, within each sector. Which one do you think will offer you more, relatively better growth with probably, hopefully, relatively better valuations?
Fair enough, and it's very, very, very well explained. Now, from the investor's point of view, you know that just in the flexi cap as a category, if you see, while fund managers have flexibility to go 0 to 100, theoretically speaking, in large, mid, and small cap, and because the liquidity reasons that you have been very vocal about, and the timing reason you have mentioned in the past also, that different and most of us know that different fund houses have kind of anchored them to different pockets of
Time.
small and mid cap exposure. Certain funds are running it like about 10% small and mid cap. We are running it between 25 to 35. Some of them are running it more like a multi cap fund, etc. Now, what kind of investor is our ABSL flexi cap fund more useful for or relevant for? And why do you find 25 to 35% small and mid cap as a sweet spot? The reason why we have anchored ourselves there, and particularly in the context of that, if you can just throw some light on our long term and short term performance as well, that would be very useful.
So I think the way I used to see, before SEBI did this categorization, and even now for that matter, the way I see it is, any wealth manager, any investor, when he first comes to the market, is likely to come into large caps. So you have clear category of, large cap funds. The next, if you want a little bit more of, alpha and a little bit more of growth, because mid caps in the longer term do better than large caps. That's history there for you over a long term. Mid cap will give you that extra few percentage points, and he wants that little bit, and that's where I thought that, in a large cap fund, it's literally 10 to 15% only of small and mid caps that he gets, if at all. But if he comes to flexi cap, I thought 25 to 35 is the sweet category, wherein basically he gets a decent experience of mid caps, and at the same time, it's less choppy, it's less wobbly, it's most kind of the experience that he can get in is not going to be it's going to be smooth. Now, if he wants a little more of risk, then there are straight mid-cap funds which he can go to, or for that matter, now SEBI has clearly categorized a new scheme, a new category, which is called the mid and small cap, the large and mid-cap category, where, again, you can get a little larger percentage of mid-cap. Or you directly come to a mid-cap fund, and then you have the small-cap funds and the micro-cap. So in my thought process, okay, this is the perfect pyramid structure. Okay, and I have placed myself in that particular pyramid, saying that, okay, you want a little bit more of a flavor and a little more alpha, you could come to flexi cap. But as you rightly said, not everybody is treating this the same as a pyramid that I'm using, because this is the only category where SEBI has allowed you complete freedom in terms of, what you really want to do. But having said that, to be honest, it's easily said than done. After a particular size of the fund, you can move a few percentage points here and there, but it's not really, it cannot move 500 to 700 bips, just because you think, mid caps will do better. It's not really easy. From that perspective, you must understand India, while in terms of market cap perspective, if my last numbers are right, I think India was the 6th or 7th largest market cap in the world. Okay, I'm sorry, but this is about 6 months dated. But on a free float basis, we were 11th or 12th rank. Okay, so primarily which states? Because in India, most promoters want to own 51% plus. Globally, that's not the way things work, right? Globally, somebody could own, someone's running a company. He could be the founder of a company, but he could have 5, 7, 8, 10, 11%, and he could still be the founder of the company, because at every stage he has diluted himself. Initially to family and friends, then to venture capitalists, then to private equity, then to IPOs. But in India, the free float's not that easy, and I think we need to be aware of that. If somebody wants to really move quickly, the impact cost is very high, and the impact cost only comes to the cost of the investor. So, my idea is always to be very clear that I will always be between 25 to 35%. I think, over a long period of time, in 10 years, we've seen that, this consistency has helped the investor to kind of know what to expect, rather than, going into a fund which will try and capture when he believes that the mid cap will do well, and run into mid cap for 70-80%. And then again, if large caps do well, try and move back there. So I think our strategy is to tell them upfront, this is what and this is where we are.
Perfect, Anil. Thanks. So now let's move to mid-cap fund, something we all are quite eager to listen from you in terms of how what has really gone right, how have you reconstructed portfolio, what are the changes that you have made that have worked and that has helped us turn around the performance in ABSL mid-cap. And for viewers, I mean, generally, needless to say, but our long-term track record in that is a bit mixed. And in that context, what we have seen over the last 6-7 quarters has been phenomenal for us, and we look forward to hear Anil's view on that.
Yeah, so honestly, I took over the mid-cap fund somewhere in last year, probably. I think it was April, May. I don't really remember the exact
date. Last year, yeah.
Yeah, last year, about May, June. Yeah, about 6. It's been about 16-18 months now. I think when I took over the fund, I dissected the fund into various ways in which you can dissect a fund. I just wanted to know how much of the percentage of the fund is into secular themes, long-term themes. How much of the fund is into PSUs, how much of it is cyclical, how much of it is value, and so on and so forth. So when, clearly realized that the fund at that point of time was really leaning a lot towards only cyclical stocks. And we did not have long-term positive themes, which, were running or where I thought one should be building positions. So we built a lot of large position in IT at that point of time, which really worked out very, very well for us over the last 2 years, because it became abundantly clear at that point of time that the world, every small business or large business will have more and more requirement of, IT, because you're sitting at home, you're working from home, you want to connect to your employees, you want to connect to your customers. And digitization was the way to go. And, on the other hand, the travel cost of the IT engineer to go on site and do the work, or for that matter, the guys to go and work on an Infosys or any campuses was coming down because you were working from home. So you had clearly good demand visibility, and the costs were coming down for these companies. And, to me, that seemed like an absolute no-brainer. So we went in, from literally 3-4% of IT to 10% of IT. We didn't have much of specialty chemicals then. And, I've said earlier too in the call today that I'm pretty relatively been positive on specialty chemicals, and I still think that it's been 3-4 years since we bought these stocks, and I still think there's many, many years to go through. So we bought some specialty chemicals. So basically, I just balanced the portfolio more from being overly leaning towards cyclicals to be more slightly, just got the composition right, number one. Number two, again, the portfolio at that time had 90-95% of mid caps. And, mid caps by nature are quite volatile by nature, because, a little bit of worry and on very slow volumes, the markets and mid caps can come down when the going is bad, and vice versa when the going is great. So I kind of, brought in some long-term large caps as well, which I was positive on, like telecom, etc. You within the SEBI rules, you're allowed to have about 35% outside mid caps. Okay, so we kind of use that judiciously to pick some small caps and to pick some large caps as well. So textiles was another sector where I thought, with the world looking at China, in a very different way, and I thought it was clear that they would look for an alternate. And textiles, unfortunately, at that point of time as well, there were only small cap companies. There were no mid cap or large cap companies. So we picked a couple of small cap companies because I was very, very excited that the next 3 to 5 years, stocks have already quadrupled, the KPR mills for that matter. So we did a judicious mix of basically, small, mid and large caps, keeping the SEBI, minimum requirement of what it needs to be in the mid cap. And we also made sure that there were a little more of secular themes and not just cyclical themes. So I think it was a combination of these two things that really worked and worked well. Yeah.
Sure, Anil. So, would you like to kind of outline some of the success stories that we have had, which have contributed to the performance? I mean, more from the point of view of the historical. I mean, what has explains our performance rather than going forward. And viewers, it's just a disclaimer that anything that we talk about in terms of success stories is purely in the context of how the fund has done so far, and it should be seen only from that perspective. So yeah, Anil.
Yeah. So I think clearly, as I said, IT, I was extremely positive on IT at that point of time. And again, being a mid-cap fund, luckily at that point of time, a lot of IT companies were not valued as the way they are today. They've run up 4 or 5 times. So, I bought a basket of these stocks, starting with Mindtree, Emphasis, Birla Soft, and I said, look, of course, you had a macro view on IT, but then you had to dig deep into each of these companies to know whether the growth rate is really coming through or not. And I was positively surprised that my thesis was right. The company seemed to be extremely positive, and over the last 4 to 6 quarters, there's been very high growth coming through some of these mid-cap IT companies. So that's been one of the success stories. I've already outlined KPR Mills. I think textiles is India is coming back and roaring back in textiles. Even if so, basically, if you go back to pre-COVID, I would believe almost 80% of textile requirements of the US were being sourced out of China, probably more than 80%, depending on the category within the textiles, towels, t-shirts, napkins, every category. But on an average, I would think 80%. And the balance being spread between Vietnam, Bangladesh, and India had a very, very small part. And the whole thesis was that even if a few percentage points move, it could mean a huge, huge thing for India and Indian companies. And again, that's kind of something played out. So KPR Mills was another big success. From a value pick, we had some decent quantities even when I got the fund in Tata Power. I actually added a lot more to that because it was going at 2.5 times EV EBITDA multiple at that point of time, and it just ridiculously cheap. And yes, that's kind of played out from 40 to 240. So generally these were some of the things that you saw. So it was a combination of basically looking at long-term themes and looking at valuations where you thought that this is the perfect price and perfect values to enter where you don't have much to lose. Lots of such kind of stories as we moved along. Yeah.
Sure. Thanks, Anil.
Sure.
Lastly, before we move to questions, please keep sharing if you have any question around any of the products that we discussed so far in Q&A box, and we would like to kind of take them up. So, Anil, in the context of particularly this union budget, how do you see manufacturing as an opportunity? Generally, the whole point is that we are a country of 135 crore people, and the employment opportunities will more open up in manufacturing than otherwise. So government focus there. Generally, our composition is more service driven, and we want to make it more balanced, mixed, etc. And a lot of government measures like whether it's PLI or recently the capex budget that they've earmarked, kind of make us believe that manufacturing will have a bright future in India. What's your view in terms of both the economic impact of that and the market opportunity of the manufacturing space?
So, at the outset, let me make it clear, Rome was not built in a day. Rome was never built in a day. It's easily said than done when it comes to manufacturing. You need to get a lot of things right to get, to basically, so there are two ways in which to look into manufacturing. One is you have units, you set up units for manufacturing products which will be consumed within the country by this 135 crore population. And then you also have ambitions and aspirations to basically set up units so that not only do you cater to the domestic demand, but you are also globally cost competitive, so you can start exporting. Now, so India, unfortunately, barring one or two sectors, was never globally cost competitive to really, export. The manufacturing hub of the world from a pin to a helicopter has been probably China. If you look at any country's largest trading partner, from Germany to Spain to Italy to US, it's common. It's China, the largest trading partner. And that's primarily because they became the manufacturing hub of the world. And when you have scale, you obviously have cost advantage. Okay. So I think while manufacturing is crucial not only for your own unit, but you also need to have good labor productivity. You also need to make sure that your infrastructure, which means roads, railways, ports, all of these are efficient, because even if one of these things is not efficient, your cost is likely to go up. And the minute your cost is going up, you're not globally cost competitive. Okay, so it needs to be seamless. And I think we made a beginning. Okay, I mean, PLI scheme is a good incentive. As you right, we've seen a lot of money being spent on infrastructure. I think that's all great, but I would still believe that the fruits of all these things will be seen at least a minimum of 5 to 7 years from here on. If from an economy perspective, from a stock market perspective, it could be much earlier, because markets always want to look ahead. But that's the way you really need to look at manufacturing. It takes a, I mean, you speak to any businessman in this country, and he'll tell you what he goes through in terms of approvals, licenses, the power cost. We have exorbitant power costs in this country. You have labor productivity. There's a myth that labor in India is cheap. It's a complete myth. It's not cheap. Okay, because you need to look at labor productivity and then see if it's cheap. So I think all these things are on the right path. The governments and the state governments are on the right path to try and correct these things. But I would just like to, caution people that, Rome wasn't built in a day. This is going to take time. This is for the long haul, and invest accordingly. But yes, particularly if you're looking at companies which will be globally competitive enough to exports. If you're looking at companies which are primarily looking only to cater to the domestic demand, then you need to be clear that there is basically they still need to be competitive enough, because otherwise you'll have some imports coming through. So I think it's a combination of various things that you need to be aware of.
So one first question we have is from Mr. Raj Shekaria. Your top 10 constitutes 50% of the AUM, and yet the fund has 67 stocks, which is a lot. What is the thought here? Is your investing style top down or bottoms up?
Yeah, I think good observation. Thank you. You're absolutely right. My top 10 are close to about 50%, but I do have a long tail. And primarily because, the last 12, 15 months in terms of the markets, and probably even a little more beyond, the market was such that, either you're in or you're not there. And, if you were in, I mean, stocks skyrocketed in matter of few days or weeks. So we saw, probably, just to give you one or two examples, Tata Motors probably almost doubled in a month. Tata Power almost went up from 150 to 250 in about 6 or 8 trading days. So point was here is it's not about conviction, but you have to markets was moving furiously and rotating furiously. And, you were just not able to build size in whichever you wanted. So if you start to buy any particular stock, you never buy everything in one go, because A, the liquidity is not there, and two, you build on your convictions quarter after quarter, month after month, with more data points as you come along. The market just didn't give you time to build convictions. And, such was the furious rally of the market over the last 12, 18 months, minus the last 2-3 months. So that's why you're seeing a longer tail. As you see markets, I think, kind of rationalizing, kind of slowing down its pace, you will see a reduction in the tail for sure.
Sure, Anil. I hope that answers the question from Raj. Second, I think you alluded to inflation in the beginning in your initial remarks. So in that context, there is this question from Vinita Vaidya. The question is, with very high rate of inflation and growth not keeping pace with it and far behind, we are not in for a prolonged period of recession going ahead. So that's the question.
I don't think so. Yeah. Is she asking from an India perspective or US or globe? I mean, is that clear?
No, it's not clear from question, but I think must be from global, because in India you were very clear that the corporate earnings are looking good.
So I think it could be more US. So look, I think while today as we speak, there are in the US everything is pretty transparent. There are already estimates that you will have probably 4 to 5 rate hikes this year, and at least another 3 to 4 next year. That's the data points. That's the data chart which is there. In my personal view, the US central bankers have literally been married to the markets for the last many, many years. And, I don't see them going through with both these years the way it's being panned out today. Okay, yes, they will attack inflation this year, and you will see probably between 3 to 5 rate hikes. That will bring, growth probably taper growth back, a little slowdown in the US, because they want to, if you want to taper inflation down, probably the growth will taper down as well. At that point of time, I think there will be a decision whether they really want to go ahead with further rate hikes or not. So, at that point of time, the equity markets could actually cheer saying, look, there's only been 4 or 5 rate hikes, the other 3 are not coming through. So that's why we need to be observant, and we need to keep watching this as we go along. But, as far as this year is concerned, where the threshold level for the US is 2% in inflation, and they are currently at 7. I don't think there's any doubt as far as the next couple of months or couple of quarters is concerned that, there will be rate hikes in the US. Now, whether those rate hikes lead to lower inflation or not, time will tell. But we'll need to wait and watch.
So since we have some more time and the questions are coming in, but I'll just come back to questions once again. But you are also managing this Special Opportunities Fund, and we had come out with this NF new fund in 2020. I think last quarter of 2020, and it has done exceptionally well. So any guidance on in terms of what's your outlook, and for what kind of investors is this fund more suitable for?
I'm sorry, but I always believe that, special opportunity by nature, there are 2 or 3 different ways in which you need to look at. It could be a particular event where the time is not in, the time factor is not in your control, but that eventually that event will take place. For instance, a demerger of a particular unit or a demerger of a particular business. That's a special opportunity. Divestment is divestment or privatization could be a special opportunity. I even think that, because of the way the globe is looking for an alternate to China, it's a special opportunity because it's only available for a few years for India to really capture that particular opportunity. It's not going to be, and it's only available for all the sectors as of now. But, I think, which are the sectors which will really be able to grab that opportunity. So in a way, it's a special window which has only opened for a few years, because if we don't fill this gap, trust me, some other countries out there which are going to fill the gap and export to the US or the Western world. So, it depends on which ways to look at it. But there's, it's a constant, constant evolving special opportunity that kind of keeps happening. And, we will need to be dynamic in that particular fund.
Fair enough. So one question is, what's the reason behind recent underperformance compared to peers? And are we taking any global exposure in our FlexiCap fund?
So I'll answer the second question first. No, we have not taken any exposure to any global stocks as of now yet. Number 1. Number 2, the recent underperformance, I think, is primarily because, as I said, I'm anchored more towards valuations. And this is something that, we've been articulating over the last 10 years. In a market which is exuberant and which will move in extremes, I would definitely underperform. However, in a market which is range bound or likely to be more rational, you will definitely see me outperforming and doing very, very well versus not only the benchmark, but even the peers, as the last 10 years of history would show. And if the markets come off, then the extent to which BSL FlexiCap normally falls is relatively less. So, that's the way it is, because, I do have, if you're anchored towards valuation, for instance, I'm overweight healthcare as a sector right now, for some time right now. And healthcare, particularly within healthcare, the generic pharma space has underperformed. But, I strongly believe that, this is probably the only sector which has come back to pre-COVID valuations. So stocks which are throwing very, very good free cash flows, sector wherein you're a global highest market share provider of generics to the world, where balance sheets are pretty fine with zero debt in most of the cases, and growing consistently at about 12 to 15%. I'm quite fine paying 13 and a half, 14 times EV EBITDA multiples versus, as I said, consumer staples, for instance, where for the same growth, I'm not comfortable paying 50, 60 times. So 50, 60 PE, that is. In the case of pharma, it is more 20s PE and 13, 14 EV EBITDA multiple. But I think, as I said initially itself, I think this will be the year where valuations will start mattering. In a full-blown bull market, people want to chase stories and hopes rather than reality. But I'm hoping that this year is going to be a year of a reality check, And in any reality check, valuations, free cash flows, and balance sheets suddenly become very important. And that's fingers crossed, but hopefully we should see us returning back to much better performance. Yeah.
Sure, Anil. Thank you. So, given
Sure.
the context that you created in terms of potential volatility, valuation, the reality check could happen, etc. Any final words that you have for our viewers today in terms of how to approach investing? So, for example, someone, I'm just making it up as an example, that someone was comfortable with say 60% equity exposure pre-COVID, and that was the say previous 8-10 years of average equity exposure of an individual, and because of the mark to market and then the gain that has happened, that exposure is say for example 80% now or 85% right now equity exposure. Would you suggest that individual to kind of write that overweight equity exposure right now, prune it down to 60%, or even reduce it below that? So if you can just give
No,
your advice in
no,
that portfolio context.
no, absolutely. Look, I mean, if you have the stomach to be fine with a bit of underperformance or a bit of equities not doing too well over the short term, it doesn't matter, because remember, every time you enter and exit, if you are when you exit you're paying 15%. If you're long term also, with the various cess and charges, you're paying 13-14% short term capital gains. So you need to be clear in terms of what is the purpose for which you looking to exit. If it is only to try and time the markets, I would, depending again on the set of the mix that you have in terms of your exposure. So if there are any particular thematic funds, then I would probably look at some of those and say, okay, this has done as well as it can. Probably I'll look to trim a little bit here and there. But otherwise, if you have a 3 to 5 year perspective, I can't see things getting too bad. In the sense, more than absolutely large deep corrections, I think it's a time correction which probably needs to is likely to or needs to happen, because we've run ahead of earnings. We now need to allow earnings to catch up, and investors just need to be a little bit more patient from that perspective. Do I have a doubt that earnings will catch up? I don't think I have a doubt. In many cases, in most cases, that earnings will catch up. Okay, they may, you may have, I have a belief that earnings will come through in FY23 X. It may so happen it may be X minus 10%, but that's fine. Part of the correction will built in. But I think the trajectory of earnings in a lot of sectors is looking pretty solid over the next 3 to 5 years. I want to worry about the next 1 year or so. But it's my job to caution, and hence I am cautioning that, and particularly because we've seen phenomenal returns in the last 12, 18, 24 months. So we need to curtail greed. We need to make people realize that each year, and that's why it's equity and not a debenture where you have a fixed coupon rate. Each year cannot give you similar returns. So you have 2 great back-to-back years of good, decent returns. I think this could be a year of maybe consolidation, maybe some negative returns a little bit here and there. But if you're a long-term investor, I won't worry. I won't really worry.
Approaching the same question from a slightly different perspective, Anil, it's more what I'm going to ask is more of a personal finance question than an asset management question. But if
Sure.
someone is running, for example, a home loan and an overweight equity exposure right now, irrespective of the underlying fund, whether it's thematic fund or diversified fund, etc., would you kind of recommend people to redeem from equities and pay off loan and move on? Or you think it is good enough to, if the horizon is 3 to 5 years, run your equity exposure and run your home loan?
No, he can run the equity exposure. 3 to 5 years, no doubt you can run your equity exposure. But at the same time, I would caution him, home loan rates definitely looking to inch up as we move along the year. All home loan rates are now flexible. So I don't think, they're going to remain where they are. You will see a little bit of inch up for sure, because, inflation is global, unfortunately, whether we like it or not.
Fair. Thank you so much, Anil, for a very
Sure.
insightful session and a lot of updates on across all the portfolios that you currently run. And for our viewers, just to kind of conclude, our FlexiCap fund has been a consistent compounder, as you would have seen on you can look at monthly rolling return over a 3-year period and 5-year period over the last 10 years. And Anil has done an exceptional job. And as a valuation conscious investor, I would say he has been not only looking at growth, but also kind of balancing it with with the current valuations in the market, and creating a portfolio which has some bit of the hedge built in the sense that there is a downside protection in some form through while remaining in equity. So that's the effort, and that's a little bit of cost that you pay in terms of being having a quality portfolio and value conscious portfolio. And that's what FlexiCap is all about. And as he has been mentioning, across all calls, across different cycles, that FlexiCap fund typically does very well across most of the time frames, except for the turns particularly, and don't know what is the top of the market, but at closer to that, typically it shows consolidation in performance, and then again carries on it with its trajectory. On the mid cap side, he has started, he has kind of rebuilt the portfolio. The early signs are kind of visible to you, and over the line, in fact, just to kind of share with all of you, for the last 2 quarters or little more than that, we have been requesting Anil, what's your view, and let's go to our partners and investors and seek money. And he has been a bit resistant that let's see the performance stabilizing, and once we have that comfort and elbow room in place, then only we go to our partners and investors and seek money. Now that time is in, and I'm very happy that this is the first mid call that we are officially doing on mid cap with Anil, and we really look forward to be a very serious and dominant player in the small and mid cap space going forward, which generally we as fund house we have not done so far. And third, on the manufacturing side, Anil talked about the fact that it's a long term game. While the economic benefits will accrue over the period of 5 to 7 years, but market always discounts the economic benefits or the otherwise well ahead of time. And Goldman Sachs research, I remember, says that typically market discounts economic trend generally 3 to 4 quarters at least, at times higher than that, longer than that period. And if that were so, manufacturing also looks to be a good proposition to have. But all the while we have been suggesting that all your thematic and sectoral fund exposure should not be more than 20% of your portfolio, all collective. It's not only manufacturing, but all sectors, all thematic exposures together. So please keep that in mind. We have been advocate of asset allocation all the time, and we continue to believe so, irrespective of which phase of the market cycle we are in. So on that note, thank you very much once again, Anil, for joining us and sharing your.
Thank you. Thank you, everyone,
joining.
Thank you, everyone, for your support. Thank you, and have a safe day. Bye-bye.
Thank you. Bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।